At 8:24 UK time on Tuesday the 18th of August, 2026, the currency market has a new driver, and it is not inflation data. FXStreet's morning note says the mood has soured as Middle East tensions return to the spotlight. Renewed jitters around the Strait of Hormuz have pushed Brent crude back towards $90 a barrel. That is the key number today, because oil is the transmission line from geopolitics into inflation. Deutsche Bank adds that stagflation fears, the toxic mix of weak growth and sticky prices, are now weighing on U.S. stocks. The dollar began the session near multi-month lows, but a competing force has appeared. Cash itself is being bought as a safe haven. Over the past day, the move has become unusual. Normally, war jitters lift gold and bonds. Instead, the latest flow data shows the US dollar and oil are being bought, while stocks, gold and bonds slide in a broad sell-off. That happens when investors sell liquid assets simply to hold cash. Bitcoin is showing surprising resilience and diverging from gold and silver, which tells us this is not a simple buy-everything safe trade. Meanwhile, Strait of Hormuz tensions are keeping Brent near $90, and analysts say renewed Middle East risk is now the primary macroeconomic threat facing global markets. Softer inflation had supported equities before this, but the geopolitical shock is overriding that positive narrative today. For sterling, euro, and yen traders, the immediate impact is two-sided. The dollar is soft against most majors from last week's positioning, yet safe haven demand is now limiting that downside. The Japanese yen is muted, rather than rallying, which confirms the flows favor US cash rather than classic yen buying. US dollar to Canadian dollar is consolidating below 1.3900 as stronger oil supports the Canadian dollar while risk-off bids support the US dollar, leaving the pair range-bound. US equities face stagflation concerns, though chip stocks are still powering higher, so this remains a selective de-risking instead of a full panic. The practical message is that headline risk from the Gulf is now moving currencies more than economic data. Looking ahead, the next move depends on the Strait of Hormuz. If Brent holds above $90, the stagflation trade tightens, central banks cannot ease aggressively, and equity rallies stay vulnerable. For the dollar, that may not mean a straight rally. It means a choppy, headline-driven market where the greenback gains on panic but slips on any de-escalation. US dollar to Canadian dollar below 1.3900 is the pair to watch, because a break higher would signal that dollar demand is overpowering oil strength. With one of the busiest weeks for data and central bank speakers, calm will be fragile. Any fresh Middle East headline could reverse today's moves within hours. Today's takeaway is this: the Forex mood has soured because oil is the bridge between geopolitics and inflation. Brent near $90, a dollar caught between multi-month lows and safe haven flows, and Bitcoin's odd divergence all point to a cash-driven de-risking, not a traditional flight to gold. For viewers, that means tighten stops, respect headline risk, and watch oil first. If the Middle East cools, expect a fast unwind. If it escalates, the stagflation trade has more room to run. That is the real signal behind the morning's risk-off mood.